Welcome to another AAIS webinar. I'm John Kadous, Vice President of Products at AAIS. Today, we will be taking a look at closing the flood protection gap, making flood insurance insurable and profitable. I'm joined today by AAIS partner reThought Flood, and our guest speakers include Cory Isaacson, reThought Flood's Chief Executive Officer, as well as Derek Lynch, reThought Flood's Chief Underwriting Officer. Together, we will discuss how flood coverage can be both insurable and profitable over the long term. We'll also address how to protect policyholders from this ubiquitous peril, strengthen your relationship with insureds, and help close the flood protection gap. Cory, Derek, thanks for joining us today.
Thank you, John. Great to be here.
Thanks for having us, John.
All right. And a reminder to our audience that we want to encourage you to engage with us throughout today's discussion. So be sure to submit your questions as they come up using the Zoom Q&A box at the bottom of your screen. We'll keep an eye out and try to address them as you submit them while we move along in today's conversation. Those we do not get to, we'll do our best to address at the end of the session when we open it up for our live Q&A portion. With that, I'll kick things off by passing it over to Cory and Derek.
Thanks, John. Looking forward to the session today. So we want to tell you a little bit about reThought. So we founded reThought in 2017. We were founded by, we're all come from model backgrounds, and our goal and mission is to close the flood protection gap. We'll be talking a lot about that. We developed our methodology with top actuaries and global reinsurers. We have our methodology totally proven now in the real world. We've been tested across multiple major events, both hurricanes and riverine events and 1,000-year rainfalls. And we really have been vetted and trusted by global reinsurers and top surplus lines companies. So we've really done quite a bit of research and quite a bit of testing, and we're very proud of our results. And now we really want to help make it more available to the world so that we can get more people covered for flood. That's the whole thrust of what we do. So we like to start with a question, which is kind of a bit, tongue-in-cheek, but who lives where it rains? And the reason we're asking that question is if it rains where you live, it can flood there. And I can tell you from personal experience that I have a property that I own that I thought never would be exposed to flood. It rained for 3 weeks in a very, very dry, flat place. And I had 2.5 inches of water in my basement, and I had a neighbor with 4 feet of water in their basement. So it can happen anywhere. And so we are seeing it happen more and more. And you can see that US sources of flooding is about 3/4 now from rainfall. And the problem is that rainfall is the most difficult to predict, and that's where reThought has really specialized. So the problem is that flood risk is the most expensive and most frequent disaster in the US. It affects everyone. There's a massive flood protection gap. And just to give you an idea, the annual losses are around $32 billion. The annual premium is only about $5 billion. So obviously that can't hold. And a lot of people are getting caught without flood insurance, with flood damage, sometimes totally destroying their homes, and they have no way to go. So 90% of the market, we estimate, is uninsured for flood, and we really intend to change that, and that's what the webinar is all about today. So Derek, why don't you talk about the protection gap?
Absolutely. One of the important things to realize is there's a reason that we have the protection gap we have, and that means that there's a number of things we need to tackle to solve the problem. The first of which is, historically, it's been really difficult to prove or show that you can insure flood predictably and profitably. And that means that insurers and reinsurers are really concerned about any capacity that they put forward to allow there to be coverage in the flood insurance market. Because where we have a lot higher degree of certainty in fire insurance or in things that historically we have a lot of experience in, they're actuarially tested, all those things, they're not as catastrophic as flood. There's a lot more comfort, but we've never had that around flood insurance. And for good or bad, because of that, we've had the federal program, but that's also, on the flip side, it's reduced the kind of incentive and the drive to solve that problem. On the same side, because agents are used to there being one option, one explanation, one source to go to, and there being requirements or not, depending on flood zone for mortgages, agents typically aren't comfortable discussing either the hazard that a property owner sees from flood risk or the value of selling flood insurance. Typically, the only thing that gets discussed historically has been the NFIP, and that's a very rote system where things get put in, you get an answer, and that is all that's there. Next, insureds don't even realize in many cases, you hear different numbers, but many of them are around 70-75% of insureds think that their homeowners or some other property policy, such as a business owner policy or a COP, covers flood, and they don't. So we have a number of issues already, which is insurers don't know they need it, agents aren't comfortable selling it, and there's a lack of good options in the market. And on top of all that, we've built and continue to build where properties are highly at risk, especially coastal locations near rivers and areas where water sources exist and can threaten homes and other buildings. But we haven't really incorporated a lot of mitigation, a lot of the solutions that we have now that can help with that, both property level, community level, as well as small items that can just help to reduce small flood risk as well. So there are a lot of reasons the protection gap exists, and they're fortunately all things we can tackle.
Great, great. So Derek, with 2/3 of all losses in flood being uninsured, I mean, that must be a horrible burden for homeowners who experience that.
Yeah, absolutely. Most homeowners, when you look at survey after survey or economic data, there's not a lot of savings there. There's not a lot of margin for most families. And on top of that, when we look at the federal insurance program, currently they don't offer anything for additional living expense, loss of use, business income coverage. And really, what we've seen historically, whether by flood or another peril, if a property owner suffers a major loss, businesses, if they don't have business income coverage, tend to shut down within the next few years because it's hard to recover from that, even if you have all your property and physical assets replaced. And homeowners can't afford to pay for their mortgage, their expenses, deal with this tragedy that's happened in their life, as well as on top of that, pay the thousands or thousands of dollars a month for 1, 2, 3, 6, 12 months while they get back on their feet.
Yeah, it's an incredible problem. So anyway, again, this is the focus of what we're talking about today, and we hope you learn about some of the answers that we're proposing. So we're going to be working again on closing that protection gap. So Derek, you want to walk us through what it's going to take to actually close it?
Absolutely. From our point of view, there's two main pillars. One is insurance and one is mitigation. I'll start on the left side with insurance. And as I said, one of the big barriers we've had is lack of capacity. So we kind of need to start that by showing insurers that they can have a predictability and a profitability by deploying capacity to the flood market. When we can do that, we have more capacity flow in. And this is an area reThought's been very successful in. As we get additional capacity, that gives us the opportunity to offer better coverage, more attractive terms, and lower premiums because we have more capacity and more elasticity in the market. As any agent will tell you, the better value they can get from an insurance product, the easier it is to sell. The more sense it makes to a customer, and it just makes the entire process better. So as we make those better products, we're looking for increased take-up rate, which means increased overall premium revenue. As long as we can maintain that insurer predictability and profitability that we started with, we can ride that cycle to close the protection gap substantially.
Great. So it seems to me that if we can't increase the capacity and the confidence of capacity providers to enter the flood market and start to provide coverage, there's no way it's ever going to spiral in a way that we want it to where insureds can get it for the price that they need.
Absolutely. And on top of all this, across all of it is the component of education. I don't specifically we don't call it out in the insurance cycle there, but we do in the mitigation cycle. Because as we do this, we have to make agents, customers, mortgage companies aware that it now exists and there are better options, right? On the mitigation side, because that's definitely a key component to truly closing the protection gap and continuing that predictability and profitability. We can use the underwriting information we have to help insurers have predictable results, to also better predict the impact of mitigations and show the value of them. And we need to bring that education again to realtors, property owners, insurance agents, and show the value of that mitigation. If we can show that value and get take-up rate for that mitigation, we'll begin preventing more and more of these losses that are preventable. Not all flood losses are, but we can really help a lot of homeowners to not only have the ability to recover with insurance, but to avoid the loss in the first place. As we gather data from that successful implementation of mitigation, we'll continually be better able to predict and show the value of it with use cases, bringing down costs and all the rest that lets us continue that cycle as well.
Great, great. So it's going to start, it seems to me, like with insurer profitability. So that's really where it has to start. And that's where reThought comes in. We have done a tremendous amount of work in this area, and we have tremendously good track record. And that's what we're going to be talking about, is how we can start with that pivotal point to be able to solve the protection gap. So again, rainfall is driving flood. Most of the flood losses are from rainfall now. It used to be hurricane. It used to be rivers overflowing, things that were honestly more predictable. And now rainfall, because it can happen everywhere, is a big, big problem. What we noticed when we started out is that because the air is getting warmer because of climate change, we're seeing more and more water in the air. That's what's driving all this rainfall. And the problem is that in the US, there are 3.2 million square miles in the US. So no single catastrophe model could possibly do an adequate job of covering the amount of detail that's required for that big of an area. It's just not possible. So we looked at other solutions and how we could work with catastrophe models to make them better, to be able to accommodate this. And we have very, very good proven results now on the rainfall side. And by the way, what I think people don't realize also is 99% of US counties have had a major flood since 1996. So it's not like you can move somewhere and avoid a flood. So a lot of people think they're not exposed to flood risk. Everybody is exposed to flood risk. And we've seen that over and over again. So the key is underwriting. And, something I've learned, I'm relatively new to insurance. reThought is the first venture I've done in insurance specifically. And what I know is that insurance is underwriting. To be able to underwrite, you have to be able to predict the future. If you can't do that, a lot of startup insurtechs that made a big splash, if you will, in the very beginning, didn't do so well because they didn't keep underwriting first and foremost as the center of their focus. And so what we know is that there are flood models in the world, catastrophe models. They're very good, but their predictions vary widely, even on the same geographic point. We have seen 2 flood models differ by as much as 150 times on the exact same geographic lat long. So what do you do with that? And which model is right? And how do you do it? And how do you decide how to do that? So what we did is we developed a very advanced flood data and analytics platform to predict flood risk with precision now. And it's been very, very well proven, over thousands of policies in several years. So Derek, why don't you talk about reThought's results? Because I think we're very proud of them, but I think it really is the key driving factor to what we're talking about today.
Absolutely. And I think there's just a little bit of history that kind of goes with this first bullet here, which is when reThought first started, we knew that this was a massive challenge. We took probably at the time the biggest challenge in the market that we could see, which was showing that you could predictably and profitably underwrite flood insurance. So that precision didn't come from nowhere. As Cory said, we've spent a lot of time, a lot of money, and worked with a lot of experts to develop a process. In that, we had to start with the accounts where you could afford to do that. So that was, larger municipal, industrial type of accounts. But what we were able to do over time is take those decisions, those data points, the results from them, and learn from them, and take that so that we could more and more automate through that process, so that we could leave the underwriters free to do what they should do, which is to look at all the information and have a final decision, and have something that, for a homeowners can pop out and have just a reliable, predictable, provable result. And then on more complex accounts, of course, you always need a person and their eye on it. But that's allowed us to automate the underwriting process and outperform anyone else that we've seen out there. We've shown a consistent profitability for our loss results. And the reason for that isn't some, absurd large charge or us saying that we only work with low risk accounts or anything like that, because we've written some highly exposed accounts, some very large values, and we've written them everywhere in the country. But what we've done is shown that our loss predictions, when losses do occur, are typically within about 15% of the actual loss. So of course there'll always be outliers. There's things in the real world we don't know, but by and large, they're very close. And that's better than anything I've heard anyone else show, claim, or review anywhere.
So
We've
Derek,
proven that.
Is what you're saying there is that if basically somebody experiences an actual 1 in 100 event at their particular property, that our prediction of that claim amount was within 15% of the actual claim?
That's right. And we've taken essentially, let's take rainfall because that's a big part of what we've already highlighted. There's stations across the country, they're official and unofficial recordings of rainfall, but they're also NOAA-based charts that tell you if you have this much rainfall over this period, if you have 15 inches over 24 hours, it's a 500-year rainfall. So what we can do is say in a 500-year rainfall, we predicted it's X dollars of loss or payout on the policy. And then when we see a rainfall, we can record it, measure it, put it against the chart and say, before we ever knew this was going to be a loss, what did we predict? And that's what falls in that 15%.
Yeah, that's pretty impressive. All right. So why don't we talk about Hurricane Debby? This was a very, very interesting storm. So there were 78% of the losses occurred in low risk zones, meaning if you're used to the FEMA flood zones, the A and the V zones and the X zones, 78% were in X zones, meaning that most of those people, probably almost all of them, were not required to buy flood insurance because their mortgage companies only use the FEMA flood zones, which are highly outdated. And that's what they're using for their requirement. They were obviously at risk. Essentially, the NFIP is expected to pay out about $300 million. Private flood insurance is expected to pay out another $1.5 billion. But there was $10 billion of losses we estimate that were uninsured. That's a horrible burden for people to have to bear. So Derek, what do people do when they have that kind of loss?
That's a good question. I don't think most people know what to do when they have that kind of loss if they don't have insurance. But yeah, they may declare bankruptcy, they may lose their house, they may just struggle to recover. Many may take money out of retirement or something that depending on their age could be multiples for them later, which takes money out of the community, it takes money out of the country, and it takes a lot of opportunity away for people. I think another big lesson to see from this is exactly the low risk versus high risk zone and the requirements. I think it stands out that the NFIP has tried and put a lot of money and a lot of time into expressing that flood coverage is needed, and they've done some work on expressing it's needed outside high risk zones. Unfortunately, with that, we see both the big uninsured gap here, but another thing we see is with these kind of upward projections of upper end projections of expected loss here is the federal government with all their work tends to be heavily focused still in these special flood hazard zones, these high risk zones, where the private market seems to be making, even though it's smaller overall, a lot more progress in educating and placing coverage in these lower risk zones, because outreach and education is key there. If a customer is told by a mortgage company they don't have to carry coverage, if no one else tells them anything, they assume they have almost no risk. If we have, somebody that is told, hey, X zone means no risk, they're probably not going to buy the coverage. So they need someone, an insurance agent, someone to step in and explain what that risk is. And the agents that understand enough to be able to do that typically have good private market options. And so I think that's a big component of why we see such a larger loss expected on the private market side when we have such a large loss in low risk zones.
Mhm. Very interesting. All right. So, how does rating work, Derek, today?
Well, in the market and historically, it's largely been zone based, and that's FEMA flood zones. That's what the federal government's done. They still represent something like three-quarters of the market, somewhere in that general neighborhood, and historically much more than that. It's shifted over the last several years, but it's A zone, it's V zone, it's X zone, and those are largely broken into two categories: low risk and high risk. We've seen, for FEMA claims specifically, NFIP claims, 25, 30%, somewhere in that neighborhood, are outside of these high risk zones. If you look at numbers from the Congressional Budget Office, they estimate in 2020 that 40 to 50% of damage, not claims, but damage, happens outside special flood hazard areas. So that's not a great method. In fact, NFIP no longer uses flood zones in their rating. And it's important they created them, but they no longer use them. So in that, it seems reasonable that probably everyone else should consider not using them as well. But that's still a method in the market. Outside of the FEMA-based zones, others will take geographic territory-based zones that are typically too large and coarse to have any good predictable result. We have third-party scores. They're often used not even taking into account the value of a building. And I'll tell you, 6 inches of water in a $100,000 building is quite a different scenario than 6 inches of water in a $10 million building. So even if those scores are great, there's a disconnect there in predictability and consistency. And finally, some will use.
We've had a question come in, so if you don't mind, I'd like to throw this one out there because I think this might be a good time to address it.
Sure.
So the question is, can your model predict the reduction in expected loss by elevating the property?
Yes.
Perhaps by converting the first floor to a basement or parking area?
The short answer is yes. One of the big key factors, of course, is building elevation. Because if you're sitting right on the ground and you have just a few inches of water, that means you have a few inches of water in the building. That means carpet soaking into the drywall. All these things are damaged. If you're 6 inches of water and you're 7 inches up, the good thing is, especially if that's a slab or something, you have zero water in your building. So we can show exactly what the benefit of having that raised is. We can, there's some large mitigation measures suggested by FEMA, such as filling in a basement, elevating a building. Those are tough sells to most people that haven't suffered a loss. But if someone does that, we can absolutely account for what does that change in their risk and what does that mean for their premium, which in the case of elevating building is typically a substantial change for a relatively small elevation.
Yep. Now, one thing I might point out as well is we have, at reThought, we have studied many carrier books, and we've had carriers come to us or reinsurers that wrote business based on territory, third-party score, single model approaches. They said to us, we did all the right things, we checked all the right boxes to be able to do it correctly, and we still had very severe losses. How come? So what we found from this is you only have to be off by a few percent to totally destroy your results. All you have to do is write too many of the high risk properties and not get enough rate for them. Let's say 5% of your book, and you could actually have a much more outsized loss from that ability. So one of the things we're very, very careful about is we can underwrite every single building down to an incredible level of detail. So we know what the risk is and we make sure that there's adequate rate. And that's how we maintain profitability and have done so for years. So it's not an easy problem, and it's very, very challenging. But as we said, our predictions are very, very good. So we'd really like to highlight that, and we'll show you a little bit more about how we do that. So.
And I think that actually highlights one last thing, just to spontaneously throw it in there. The question of elevating a building or a building already being elevated. There are a lot of approaches in the market that do not account for that. And as I said, that's a critical thing, and that's a missed opportunity to make flood attractive if it's not accounted for.
Yeah, definitely. So this is a very complicated situation. So Derek, how do people do this, and what do we do to make it better?
Well, probably I would say the majority of people likely to be on this call understand typical insurance to a degree. Insurance has historically been actuarially based, still is in the majority of perils. And when we take an actuarial approach, just to simplify it, and some actuaries on the call may always take a sitting there. It's really hard to say this year, will it have a fire? And if so, how much damage will we see? But it's a lot easier to say if we have 10 years of history for 5 million buildings or 10 million buildings, what's the average number of buildings that will have a fire and what's the average damage? And that gives us a really good way with a few components of, construction, protection class, those things to develop pretty solid rates. Now, what we have had is a lot of storms, a lot of flooding in the last number of years, especially. But unfortunately, or fortunately, we haven't had the degree that lets us build that confidence of a particular type of storm in a particular geography to take that actuarial approach and have it really be meaningful in any way. So what we do is we use the tool known as CAT models. And what they do is they build out simulated possible futures. They take and say, ideally, it was a storm. It was heading towards a populated area. It shifted a little bit and hit a very much less populated area. That was quite a different result than we would have seen. So what CAT models can do is say, what if this storm was a little further north or a little further south? A more populated or less populated area. It was a little stronger, weaker, faster, wetter, drier, high tide, low tide. And then we can take that with all the events we have, and we can use that to develop a catalog of simulated storms that we can now take a much more similar approach to an actuarial approach.
Great. So is there a best model, Derek? Is there one you can pick and just rely on?
Yeah, we get asked that all the time because we reviewed a lot of models, a lot of data sources. We've tested them out. The answer is no. And the answer is no because every model has its strengths and weaknesses. There are a lot of sources they start out with that are the same. There's some that are proprietary or built by them, but they're all used in different ways. They all have the resources they have and the expertise they have, and that causes them to be better or worse at certain things. No model is perfect. As you said, the country's huge. That's a lot of ground to cover.
Mm-hmm.
So the key is, what do we do with that? They're not perfect. None of them are perfect, but they're better in one area or another.
So I've got another question here that I think would tie in very well with the discussion here on models. How do you separate or distinguish damage statistics and models for flood from that resulting from storm, from wind, tornadoes, et cetera, when assessing both damage and claims projections? So how do you separate out flood, and you talked about a lot of that flood being rainwater driven as opposed to being hurricane and other exposures? So how do you separate out those CAT exposures from the general flood exposures, I guess is what we're looking at here?
The CAT models themselves do the heavy lifting on that, which I think the simulations of that are easier than the real world because the simulations can say this happened or that happened, right? And so we have concrete things that occurred to the building in that scenario. A lot of the challenge comes after the storm and when we don't know things. If the building's not there anymore, did it get blown away or did it get washed away? Was there wind damage before the water came, or did the water come in and recede and then something else happened? If there's water damage, did it come in through the bottom or did it come in through holes created by the wind, right? So there's a lot of things that, especially if someone's evacuated, we just don't know. And then it comes down to figuring out what those things look like, what's practical to separate, what jurisdiction we're operating in, because it may be different by jurisdiction on how it's handled if we have concurrent causation or not. So I'd say, the models have down how to separate those things out because in the simulation, they know exactly what's happening. A lot of the challenge comes in the real world when we can't necessarily prove what happened, when, and what order, which creates a real challenge on how we separate those out.
Right. But for a rainfall flood, Derek, it's pretty obvious after the event, right?
Right. And yeah, I was mostly referring to storm surge because I think that was the focus of the question, but rainfall is typically a lot easier to separate out. And as we said, that's the better part of claims right now in events.
Right. But it's a lot harder to predict because it can happen anywhere. So,
Yeah. Although
Hopefully
severe
that'll help.
convective storms in general are on the rise, we hear that over and over.
Yep, they are. All right, so if there is no best model, what can we do to approach this? So I know one thing we do at reThought is we used our own AI technology to be able to focus on this problem. And the idea was not to replace catastrophe models, but to make them better. That was the initial focus. And catastrophe models use footprints. And what that means is they use what we call a top-down approach. And the way that works is they will simulate an event that has a certain footprint, maybe a certain geographical size and shape where they think that event could happen. They make thousands of those events and then they spread them, throughout the areas that they cover. And again, the problem is it's just too big of an area to have enough events to be able to run the model and get anything useful if you were trying to do enough detail. So it's good, but it's not good enough. So what we did is we developed our own AI capability that ran a bottom-up approach from detailed information about each building. So rather than a footprint, we did it from each location or building. And we did this on well over 100 million buildings in the US. And so from that, we get another point of view of what the risk is, and we're able to use that to apply to the problem. And we'll show you a little bit about how that works coming up here. So Derek, if you want to walk us through how our model convergence works for a better understanding of risk, I think that would be very helpful.
Yeah, and I think the application and timing of this whole system is important as well, because as we mentioned, there's flood zones, there's third-party scores, there's all these things outside of models, which could be great supplementals, but really don't do a good job at quantifying risk. Many that have tackled the flood coverage problem only run models afterwards on portfolios. So using the tools early and often is important so that we don't have knee-jerk changes in the market. But when these are run, the majority of people that use cat models are going to use a single model, get a single output, and there's not much they can do to make any distinction or better inform those results. And they're generally not looked at on a granular level anyway. They're looked at more of a portfolio level. Those that take it further, which often are professional consultants and maybe some large reinsurers, will use multiple models. They use those multiple models and they either get separate views and just take those overall views, or they may average them, which is always a potentially dangerous exercise because you could be taking good inputs with bad. And it's better because it gives you some idea of the different viewpoints, but it's certainly not sufficient. So at reThought, what we do, as Cory mentioned, is we not only run the multiple models to get the views to see the strengths, the weaknesses, the differences between these points of view. We use our own technology after that to identify where those strengths and weaknesses are, the credibility of each model in each case for each building. And we use that to develop our own specific view of each building. And then we can roll that up to a policy, a portfolio, a state, or a country view. And so that really not only takes multiple viewpoints, but takes their credibility in an informed manner to get a much better result than would otherwise be possible.
That's right. And averaging in general is very dangerous, I know, because if you have, for instance, if you want to cross a river and you know that the river is an average of 3 feet deep, it could be 20 feet deep in the middle, and you don't want to get caught by that without knowing it. So that's one of the reasons that we realized we couldn't do that. So by doing this, we get a much more accurate prediction of the risk. And as we said, in the majority of claims, we're within 15% of what the actual claim amount is, which is pretty darn good. So it's worked out very, very well. And this is just not just a few policies. This is many years of underwriting flood across thousands of policies. So we have developed from our AI engine. We did this all in-house. It took us years to do this, but we have something called a flood resilience score. What that is it's a positive score from 1 to 1,000, meaning if you have a high score, your building is more resilient to flood. We wanted to do this because we want to take mitigation into account. So we're the only ones who developed a positive score instead of a negative one. But what you can see from this is a 1 square mile view, and you can see the score of every single building in that 1 square mile. And what you'll see is there's lots of gradations of color here in this area. You can see the yellowish and orange and red. The red are the worst, the lowest scores. The green are the better ones, and the yellow going toward that way. But if you look here over in this area, you'll see that sometimes the red and the green are right on top of each other. We have proven it that you can walk sometimes 3 to 5 minutes from one building or home to another and have many, many multiples of the risk in that characteristic. So this was really, really important. And so we use the flood resilience score and use that as the main tool to be able to figure out which model is best and by how much. And from that, we get a very, very good prediction of what the damage would actually be. And from that, we can quote an adequate rate so that everything is sustainable and profitable. So that's really the key to doing the whole thing. And as I said, it took us years to get this right. This was not easy to do. And we now have completed this for some time now across the entire US. And so every building that sticks up, we have identified and done this exercise on. So now let's talk about the things that are really important to close the flood protection gap. So just having the best technology and being able to underwrite it is not going to do it by itself. So Derek, product coverage is really important, isn't it?
Absolutely. What you don't want to have is somebody buy the coverage that they can, especially if it's the broadest coverage available, and then have a big gap still. So we had the challenge of getting people to consider and purchase flood coverage. But on top of that, we have the problem when we're looking, for instance, at the federal program and a number of private market options as well, that their piece is missing. So, of course, we want replacement costs. We want it to be similar to what people know from their typical homeowners or business owner policy or the policies that they're used to. But, when we look at something like NFIP and we have secondary dwellings that may have reductions in coverage available, if we can't get replacement for contents, or a really big two items is severely restricted basement coverage, where very little building and almost no contents whatsoever are covered. We have a small list of a couple individual items, and that's it. So that leaves a big gap, both in either replacing a building or people's stuff, especially if it's in a lower level. But on top of that, we have things such as additional living expense, rental income that we talked a little bit about earlier. The average business owner, the average person with a house, if they have any form of notable flood loss, are going to be in real trouble if they have to pay for somewhere else to live for any period of time, especially if they're also having to pay for the cleanup and replacement of their stuff without insurance. And I would point out the current prediction that I saw, which I believe was very recent for August, came out a few days ago for the National Disaster Relief Fund. They're expecting something like over a $6 billion shortfall. So if people are expecting for the government to come in and pay for things if there's a large loss, they may come in. I've seen average payouts, I think, on that order of a few $1,000s, which is certainly not sufficient. But when they're projecting a deficit, they're going to have to be that much more selective in what they pay.
Right. So what you're telling me is somebody could buy a flood insurance policy, have a loss, and have a lot of it not be covered. That would be horrible. And I think people expect their flood insurance policy to be on a par with their regular insurance, their general insurance. And that's really how we think it should be. And so we've worked very hard on policy forms that do provide that coverage so that you can get what you actually need to repair. Cool. So then how are we going to get people to know about this?
As I said, education's a massive component here. There's first, insureds or property owners need to be aware that there's a need for the coverage. That's both there's a hazard and a potential for a loss, which many think if they're in an accident, those things don't exist, as well as the awareness that they don't have the coverage now. So that's step one. Next is we have to have a little bit of education around risk appropriate pricing by showing what someone's hazard is and what we're covering. And part of that is, especially through prior to NFIP 2.0, there really was not risk-based pricing for the majority of the market. It was based on flood zones and concepts and equations that were built in the 70s and really were subsidized heavily, interestingly enough, by many small or less wealthy homeowners were subsidizing those with more wealthy homes. And that's one of the reasons that they moved to their newer rating methodology, is to solve part of that. but there's definitely a general lack of awareness of risk-based pricing because it's been run through the federal government for decades. Once we educate consumers, the method we can do that by is insurance agents. And the state of Pennsylvania recently had a task force that did a big survey, and they talked to people, and they said there are three experts they look to for flood: real estate agents, mortgage companies, and insurance agents. For the first two, they really, for the most part, only look at flood zones. For realtors, it's is it required? For mortgage companies, it's checking a box to ensure that the federally backed mortgages meet requirements and they don't get fined. And so those two, beyond that, look to the third one, insurance agents. Insurance agents, as I said, unfortunately, flood is one of the weakest parts of education for insurance agents. So we really need to provide them not only education, but the tools to help educate others. And we also need to add into that mitigation. We need to help consumers, property owners with what I'll call attainable mitigations. As I said, there have been, these big FEMA ideal mitigations out there for a long time. Fill in a basement, raise a building. And if you can do those are great, but most people won't. So we need to also educate on attainable mitigations, whether they're deployables or something simple like backflow preventers, where in a flood, the water table raises, water may not come into your building, but it may come back up through your pipes. So we really need to educate on those, and wherever possible, federal, state, insurance policies provide incentives for that mitigation as well.
Great, great. All right, so, and then how are we going to let people know about this?
Every way we possibly can. As I said, a really big outlet is really going to be insurance agents and brokers. They're the trusted source for realtors, mortgage companies, property owners. So a lot of it's going to flow through them. But there are other methods too. Communities have become more and more aware as we've had these increased rain events that they need to educate their populations. They need to protect their populations. So we also need to work with individual communities to give them both the information to help protect their community as well as to educate their community. Many communities have funds set aside. They have people that are tasked with these kind of educational mandates. And so we need to find the best ways we can to help them, because something like 2/3 of flood losses are currently not insured. Something like 90% of the country is not insured for flood. So the answer is every way we possibly can, including webinars like this.
Great.
I have a question here that came in a little bit ago that I've been waiting for the right opportunity to ask you guys, because I think this is a terrific one. Has a model taken into consideration the infrastructure of the local area, like rating fire departments? Are communities with better building codes of water mitigation and maintenance ranked or valued differently? And then she goes on to give an example. In Connecticut, maintenance, let's see, in Connecticut, we had a 100-year, 100-year flood. Surface water taking out structures, and it turned out that drainage pipes were substantially blocked with debris prior to the rain event. This kind of, to me, feels a lot like, well, the wildfire side of things and how wildfire mitigation comes into play. And I'm kind of looking at this and thinking, as you're talking about the communities, mobilizing communities, and how does that, at this point, I mean, does that impact the rating or insurability?
Some yeses and nos in that. So how's it taken into account? There are things on the federal side, like the community rating system, where they take, submissions on a lot of these factors and will give discounts in the federal program. That's a fairly rote thing. They're looking at changes on that because I think they've deemed that the way they go about it is not sufficient, is not the best way to go about it. On the private side, community level mitigations are taken into account in the modeling. They're taken into account in the modeling different ways, and different ones are by model. So that's where there is no best model, right? One model may have great information on levees in one area and be missing a community mitigation in another. How they account for those levees, and the potential for overtopping, failure, the pumps fail, so they're designed to protect you. But in Richmond, I believe it was Gaston a number of years ago, they closed the flood walls that were intended to protect the city, in an area of Shockoe Bottom flooded up to the second story because all the rain that fell couldn't get out of those flood walls. So what they know and how they take that into account and how they take failures such as that possibility or the levee failing or overtopping is different by every model. So it's taken into account, but that's one of the areas where realizing what's occurring and what makes sense is really important. As far as drainage system failures, that's something that the models generally, I don't believe, have enough really information on. In a lot of cases, municipalities don't either. So where it's lacking is difficult to fill in. One of the things that's great about what we do is it may not have direct information, but by learning and seeing the patterns and the things that lead to these issues, AI with enough information does have the ability to be predictive where these issues are more or less likely to occur. And that helps inform the models that may or may not have that information and sort between them. So yes and no.
That's right. That's right. And I have actually seen this happen. I used to live in San Jose part-time in San Jose, California. You wouldn't think that's a big flood area. The truth is there are a lot of A-zone exposed buildings there, but there was a very, very long, heavy rainfall, which happens in California a lot. And the Army Corps of Engineers or whoever was managing it had to open up a dam to relieve the pressure on the dam. It flooded the entire downtown San Jose, right in the middle of Silicon Valley. It was amazing actually to see what happened. There was 1 to 2 feet of water everywhere. So great. So, and then claims is really important too, right, Derek? So we need people who know how to assess flood damage. We need third-party administrators who have experience with that. We've already worked with some that are fantastic at this. And so that's really important to wrap up the whole coverage. So,
Yeah, unfortunately, a lot of carriers don't have flood expertise, and those third parties are required for it to be fast, fair, and as seamless as possible.
that's right. That's right. So again, we really are focused on closing the flood gap, the protection gap. We know that we can make flood insurance sustainable and profitable if correctly written. We want to educate brokers to be able to do this. We want to offer flood coverage that's full coverage so that people really are protected so that it has a good reputation and not the opposite. And we want to encourage mitigation. And so by doing this, it really will help to strengthen your relationships with your insureds. It'll keep them protected. It'll give you additional premium and profitable income that you can actually use to expand your own organization. So that's what we think is really, really critical to be able to accomplish this. And so,
I think that it's going to become both a wedge and a moat going forward because we're seeing so much more activity. If property owners never been talked to about flood insurance, or they've only ever been offered the federal program, it's a potential wedge to open up the rest of the business for a new broker. If someone's really taking care of this and a new broker comes in and never mentions it, it's a nice moat of not only one more policy placed, but showing attention and expertise in an area where attention and expertise are very lacking right now.
That's right. And we want to make flood coverage ubiquitous. So people wouldn't even think of not getting flood coverage along with everything else or offering it. So that's really our goal that we're working toward. So so with that, John, we have a little bit of time, I believe, to take some more questions.
We have a very little bit of time left, but yes, we will certainly take questions. And so go ahead and click that Q&A box and put your questions out there. If we don't get to them right now, we will respond to those after the session has ended. And I just want to say, having I love the focus here on communication and making sure that the insurance consumers are aware of what they have and what they don't have, essentially. So and the opportunities for mitigation as well. 2 months ago, I had the opportunity to go back to my hometown 1 month after it had been devastated by a flood that, I'll just say, the city had never seen one quite like that before. And in talking with a lot of people, I heard two lines repeated all the time. My house is not in a flood zone, so I didn't have to have insurance. Didn't have to have flood insurance. And the other, I thought it was included in my homeowner's policy. So yeah, there's a lot of work for all of us to do, no doubt about it. I have one question here. Have there been any changes to the CBRA/OPA designated areas and the NFIP offering flood coverage?
So Derek, why don't you take that one?
Yeah, I'm not aware of any. I know that especially post implementation of it was called NFIP Rating 2.0 Equity in Action. I think it's changed names maybe twice since then officially, but I know they're looking at community rating systems. They're continuing to review the 2.0. They're looking at how better to come direct to consumers. I have not heard anything about them looking at amending the coastal barrier reef areas or those similar geographies.
All right, perfect. And I think we'll do just one more here that that I've got. And so we have oops, I guess I see it. Oh, no, that question's already been answered that I'm seeing up there. But question about situations where the I'll just say the ground has been modified. So something has been hardscaped. What used to be a field is now a parking lot with a department store on it. Those areas, does the model recognize how that has changed over time?
Yes, and ours recognizes that quite a bit quicker. It does take a good deal of time typically for new events as well as changes such as that to work their way into the results of the catastrophe model event sets. They're, very cautious in the gathering and putting together, and it's a big lift to get them into that process. As we rerun, our AI assessments and such, we do pull those results in a bit quicker to inform how those look against the current model results. So it always takes some time. It's not instant for sure, but it shows up over time, and depending on which part of the process we're looking at, that time frame can be a bit shorter or a bit longer. But it does show up. It's just a question of time frame.
All right, fantastic. And on that note, we're going to wrap it up. There are a couple questions out there we're going to need to follow up with you folks on. So Cory and Derek, this has been a great discussion. Thank you for the engaging conversation today. And thank you to our attendees for your engagement and all of the wonderful questions that you submitted. That is all the time we've got for today. I want to thank you all for attending this AAIS webinar. If you missed any of the discussion, you'll be able to watch a replay from our on-demand library on the AAIS YouTube channel in the coming weeks. We'll also send a follow-up email with our contact information as well as a link to the video recording. And please feel free to contact one of our engagement executives with any questions, or if you would like an introduction to our partner, reThought Flood, or need information about any of our AAIS products and services. Please enjoy the rest of your afternoon.
Thank you very much, John. Thanks to everyone attending as well.